Okay, so now let's continue and do the adjusted trial balance. Now that we've done the adjustments, which was a depreciation expense here and supplies expense here. So let's carry over all the debits. $97.50 for cash, $15,000 for accounts receivable. Computer is $5,000, and now we have a balance for our accumulated depreciation. Our supplies have went down. Remember, we did an adjustment, so that's at $200. Accounts payable has not changed. Owner's equity has not changed. Revenues has not changed. The draw account is still at 1,000. We have expenses at $250. And now I have two new expenses. And I should be balanced, $34,000 and $34,000. That works. So now what do we do with this? As I move this over, we're done with the general ledger for a while. Now we're looking at being able to do an income statement and a balance sheet. Pull our numbers off. So again, what you do, we know what our revenues, we know what our income statement accounts are. Those would be revenues, right? And so we'll pull that over. A draw is not a revenue account. That's going to come into place when we do the equity statement. So that stays. We're going to do $250 expense on the credit side here. So $250, $2,500 is an expense, and $300 is an expense. Now these don't balance, and the balancing number is the net income. And well, that was interesting. This is the balancing number. So let's put it over here. This is our net income. And that should equal $16,000 if it is correct. And let me pull this here. Let's make sure we're correct. Oh, it does. So now we balance here, and we have net income. Now, we want to pull down also, or pull over, our balance sheet numbers here. So let's see what we can come up with. Again, you're looking at this area right here. You're looking at the trial balance. So we have a debit of $97.50 for cash. I have a $15,000 credit for accounts receivable. I have a $5,000 credit for the computer. I have a $2,500 credit for the accumulated depreciation. My supplies are at $200. My accounts payable is at $500. See, that's a credit. My owner's equity is at $15,000. And that should be the tail end. Oh, I have, this has to come over first. The draw, we can't forget it. That goes on my balance sheet too. Now, if you look at the numbers before we put in this net income here, you'll see this doesn't balance either. The balancing number for your balance sheet here becomes the net income from here. So now I have $30,950 and $30,000. So if the balancing number for the income statement is the same as the balancing number for the balance sheet, you've got it complete here. Now you're ready to pull off financial statements. And that's relatively easy now. You've already got your numbers. You just need to kind of plug and chug. So our revenue is $16,000. Our expenses are $250, $2,500, and $300. Oops, I got happy there, didn't I? And $300 down here. And my net income is $12,950. Now remember, you do your income statement, then you do your equity statement, and then you do your balance sheet. So what was my beginning balance with my equity? Actually, it was 0. And they invested $15,000. We're going to add the net income and subtract the draw. And those numbers all come from up here. And that amount would be 15,000 plus 12,950 minus 1,000 should give me a total of 26,950. Now that becomes my new ending equity balance. And now I can do my balance sheet numbers. Let's see if I can pull this up far enough to... No. Assets are... I guess I can. Cash is $97.50. Accounts receivable is $15,000 from above. Supplies is $200. Computer is $5,000 minus the accumulated depreciation. Remember that, $2,500. And that will give me total assets of, we'll find this one, I can, $27,450. Okay, let's make sure we've got it correct. I now have accounts payable of $500, and my new owner's equity is $26,950. Now, does it balance? I have total assets and total... Why did that come up? That's just be liabilities. So now you have a balance sheet and it's balanced. But we still have a problem. And that problem is this. Okay, if I compare this balance sheet to the general ledger, it doesn't agree, does it? At all. I mean, if you just look at owner's equity. Owner's equity says it's $15,000, and this balance sheet says it's $26,950. So there's one more step we have to do, and that is called closing temporary accounts, and there are 4 entries to do that. So we're going to do that in the next video.